shareholding and ownership is one of the key areas of change in the new Act. So previously, the Act did have reservations on ownership in terms of quantitative measures. That is, you can only have up to 10% voting rights in a bank. But now that definition of material interest has been broadened. To that matter, controlled operating policies. Then such parties are also now termed as having material interest. So you can't have material interest unless it is approved by central bank.
Banks are going to have to step out of their comfort zones very, very soon, because most banks have their key customers. They have been progressively lending to those customers and building very strong and stable relationships. All that is going to be now restricted because of the regulatory norms that have come in. So they are going to actually have to diversify their customer base.
With the large exposure policy that is mentioned in the Act, ability to lend to large conglomerates or any client, your single borrower limit is coming down from 30% of the total capital to 25% of the tier 1 capital. At least 20 to 40% of SBL limit will come down by 20 to 40% in a lot of the banks, right?
Okay.
So that's a big change. We've never seen anything like that. So with that, what will happen is banks will really struggle to run with the current capital structures.
Hello, you're with Decision Points on Echelon, and today we're discussing Sri Lanka's new Banking Act with a panel consisting of Malinda Boyagoda, who is Partner, Audit and Assurance and also Industry Leader for Financial Services at Deloitte, Sri Lanka. We also have Ruvini Fernando, who is Head of Strategy, Risk and Transactions at Deloitte, Sri Lanka. And with us is also Bingumal Thewarathanthri, who is the Chief Executive of Standard Chartered Sri Lanka, and Bingumal is also the Chairman of the Sri Lanka Bankers Association. So, Malinda, Ruvini and Bingumal, welcome to Echelon. And let's start with you, Malinda. The Act is before us, and what in terms of the new Act, in terms of shareholding and ownership, how does it change the landscape?
Yeah, so Shamindra, that's an important point, and shareholding and ownership is one of the key areas where there is a change in the new Act. So what primarily comes into play is this definition of material interest. So previously, the Act did have reservations on ownership, which is in terms of quantitative measures. That is, you can only have up to 10% voting rights in a bank.
If you're an individual?
If you're an individual, you can only have 10% shareholding in a bank. But now that definition of material interest has been broadened, right? So now, in addition to the quantitative definition of 10% voting rights, if a person, let's say, has the right or ability to appoint a CEO of a company or appoint directors in a company, or to that matter, control the operating policies, then such parties are also now termed as having material interest. So you can't have material interest unless it is approved by central bank. So that's a key change that we see in the new Act in relation to shareholding and ownership.
Bingu, if I can bring you in, what does this mean for compliance and governance? I'm sure you as a CEO spend a lot of your bandwidth on compliance and governance. What does the new Act mean for the work that you do?
Shami, just to take you back, now we need to look at where we were. Like, we were working with the 1988 Banking Act. That was a very impressive document at the time, 88-page document. From there to now, it's now close to 40 years. We've been working with the same act. There had been some amendments in 2006, but post that, the GFC, the global financial crisis, happened. Basel III, Basel II, Basel III, 3.1. All these measures have come in, and I think it's high time that we amend the Act. That's the first thing I would like to say. So yes, cost is a big element here, but we have no choice. Now, on the compliance side, anyway, banks are taking massive compliance costs because of financial crime, cybercrime, etc. On top of that, for the Sri Lankan banks, I think working on this new Act and looking at the framework, more importantly, the monitoring. One is related party monitoring. The other one is the KMPs, the key management personnel. There are new criterias. You need better experience, better qualifications. Central bank will finally decide who should be appointed. So finding new people, paying them more, all these costs will come into play, right? But this is very common in matured markets. But the biggest thing that I see here is in terms of cost, the capital cost. Because this has a big element around the capital, liquidity, and governance. Those are three areas that they were trying to manage. With the large exposure policy that is mentioned in the Act, basically your ability to lend to large conglomerates or any client, your single borrower limit is coming down from 30% of the total capital to 25% of the tier 1 capital.
Wow, that can halve your exposure in some
At
cases,
least
I'm
20
sure.
to 40% of SBL limit will come down by 20 to 40% in a lot of the banks, right?
Okay.
So that's a big change. We've never seen anything like that. The other thing is on the large exposures, today you're looking at 15% of your core capital. Aggregation of all the 15% clients can go up to 55% of the total borrowing. That's the second check, right? That is coming down to 10%. Right. So with that, what the next thing is, we also look at RPTs, the subsidiaries of these companies, the holding company structures, and we can go into details, the directors and their involvements and all of that. So with that, what will happen is banks will really struggle to run with the current capital structures. So a lot of the tier 2 capital will be irrelevant at that point. You need to bring more tier 1 capital in, and capital has a cost. The capital cost has gone up significantly with US rates going up. Hopefully, with the easing cycle, hopefully by end next year, the capital costs will come down in the emerging markets, and we have time for this. So that's the other good news about this. So we will start monitoring from 2026 January. Full compliance, you have to be compliant by end of 2028. So we have time to bring the capital in. We have time to manage the SPL. So a lot of time given to manage this. But the capital cost is something that I would say a big cost. And the other important thing is, to bring foreign capital in, your ROTs has to be around 18 to 20%. Today, the industry ROE is about 13, 14%, right? But generally, when a foreign investor come to a emerging market, they look at very high ROTs, because even global banks now deliver.
You will have to define ROTE.
Return on tangible equity. So we generally look at return on equity. Now it's gone to the next level of return on tangible equity, right? So generally global banks deliver 13, 14% tangible equity. So that's the level that the global banks are delivering. So domestic Sri Lankan banking sector should be a minimum 15% as an industry, in my view. And to attract capital, you have to fire at like 18% ROTs. Now that will also have a cost attached to it, because you have to be lean and mean and all of that. You have to make sure that your cost to income ratios are down. So there's a separate cost attached to bring that cost down, in terms of automation and all of that. So long discussion, but the right path in my view. It will have its own pain, but we'll move forward.
So Ruvini, this opens up the conversation to what I'm about to ask you. How will banks, do you think, approach this strategically? Will they have to sort of relook at their established or current business models fundamentally to make these changes?
Yes, Shamindra, I think this brings us to a very sort of key point in the journeys of most banks, because as Bingu said, this sort of creates a significant change in the way they operate. And those ratios that he mentioned, the way that they have adjusted, I think banks are going to have to step out of their comfort zones very, very soon, because most banks particularly have their key customers. They have been sort of, progressively lending to those customers and building very strong and stable relationships. All that is going to be now restricted because of the regulatory norms that have come in, right? So they are going to actually have to diversify their customer base. They'll have to augment their capital. That involves a new set of challenges. It means basically going out of your comfort zone, looking for new areas of business that they can engage with. And also because what you can do with your fund base in terms of lending is going to be restricted, or is going to not grow as fast as it used to perhaps. You'll also have to look at offering alternative services which are fee-based.
Right.
So I would expect that banks will now focus more on fee-based advisory.
Which aren't so capital intensive.
Which are not capital intensive, but more advisory and, fee intensive work. So that's one aspect. And building these new customer bases, essentially, you have to then move towards the unbanked as well, or those who are less banked and less creditworthy. So which means, once again, being innovative about the kind of solutions you can offer to them. Number one. And as Bingu said, also this involves extra cost. The new regulatory frameworks then and the other things that you have to do involves some sort of increase in cost. So which means, once again, I think the use of technology in all aspects of the bank, not just in servicing customers, but in managing your internal matters, in reducing your operating costs. The use of technology services that can bring your cost down overall will also be another material part of their sort of change in the business model.
So Bingu, let me bring you in from where Ruvini stopped, and this links back to how you started the conversation also. How will lending decisions at banks be impacted, especially when it comes to large corporates? What are the implications here on the corporates themselves who have been borrowing from these banks for a long time? And how will banks have to redefine these relationships?
Yeah, so you'll have to work with limited amount of capital. So you have to now look at, you have to basically take some calls. I think banks might have to move away from portfolio-led returns to client-led or even transactional level returns. When you do a transaction, especially if you do a term transaction, that takes a lot of capital. And if it's not secured, of course, there's a larger problem. So then looking at the transactional return is something that we have to embed in our lending decisions. Today we look at relationship returns. If the relationship is making money, that's okay. That's how we look at it. The problem is if the client moves the short-term loans from you to another place, and if you're not priced your long-term loan properly, you might end up with very low returns with a large client. So especially dealing with large clients, because you have limited capital, what you bring to the table at what price will be a big conversation. We call it RORWA, RORWA, return on risk-weighted asset. So risk weight is another thing that you will look at on every transaction to see what the risk weight is. That is, they are in the system at the moment. All the banks look at it. But there will be a very stringent control on this, and the credit committees will look at these things. And sadly, some of these large corporates will have to move out of the existing banks. Beyond a point, the banks won't be able to lend. They'll hit the cap, and they'll have to work with multiple banks. All these groups, large groups, work with at least 4 to 5 banks. They might go beyond that. The other important thing is they will have to access the capital markets.
So is my understanding from the conversation so far, is that this has the new act has a disproportionate impact on the large corporate business that banks do versus the consumer lending that banks do, and obviously the fee-based income is unimpacted, I suppose. Is that understanding accurate?
Yes, the impact is on the large entities. Yeah.
Okay, let me bring you in, Malinda. So you are partner in charge of audit and assurance at Deloitte, right? And in your role in audit and assurance for a firm like Deloitte, what new challenges or expectations does the new Banking Act place?
Yes, again, an important question. So, couple of things. One thing, if I focus on the financial reporting side, it does not necessarily only impact the auditor, but it also impacts the bank as the financial preparer, statement preparer. So, the new requirement is from one side, you need to finish your financial statements and be ready with the audited financials within 2 months. So that I don't necessarily see it as a big problem, because if you look at all the big banks, even today, they do report within 2 months. But let's say some of the multinationals or some of the other banks where certain amount of audit work is dependent on your parent entity, then this might create certain amount of additional work that needs to be done upfront to comply with the requirements. So then on top of that, there are auditor rotation requirements. So in this country, we haven't seen auditor rotation requirements being there in the banking sector previously.
Are they in the statute otherwise?
It is not there on the listed company side, but that is also limited to partner rotation. But we haven't seen auditor firm rotation in this country up and until now. So the Bank Act clearly brings this aspect in. And it's a bit of an aggressive timeline that they have set in as well. So every 6 years, the audit firm has to rotate. And every 3 years, the partners will have to rotate. So now if you compare this with, let's say, like the EU regulation or the UK regulation, it's a 10-year mandatory tender and a 20-year rotation. So a firm can be there for about maximum of 20 years. So comparing 20 years with 6 years is quite an aggressive timeline that we are looking at. And the audit partner getting rotated within 3 years, again, a much shorter timeline. But that's what the Act has brought in. So in addition to these two elements in terms of auditor rotation as well as the timelines in reporting, it has also put onus on the auditors on certain reporting requirements. So when you audit a particular bank, and if you come across certain things that you believe is important on the stability of the bank, anything that can impact the deposit holders, then you have an obligation to report that to central bank. So it's now an explicit act requirement for you to make that reporting. So again, so these are additional requirements that are put on the auditor in terms of their responsibilities.
So, Ruvini, we've set the stage, at least so far, in discussing what it means to the commercial banks in Sri Lanka. But if you extend our view a little beyond the commercial banking and look at the larger financial sector in Sri Lanka, do you anticipate the implications of this act to impact the larger financial sector? And if so, in what ways?
I think Bingu referred to this very briefly when he spoke, because the banking sector's ability to service the economic needs of its clients and the country's needs in general is going to get ring-fenced to some extent. So then you naturally should see an overflow of that demand and the capital requirement going into other areas. Namely, I would think the capital markets. As you know, Shamindra, for a very long time, our capital markets have been sort of less than what their potential could be, right? Our stock market, for instance, is quite still a very small fraction of GDP. Debt markets are very inactive. The secondary market for debt is sort of, debt does not trade. So
you're referring to corporate debt here, obviously.
To corporate debt markets, yeah. So really, I think we are coming to a stage where we would actually see the capital markets get more activated, both on the debt side and equity. Also, if you look at other forms of funds, for example, collective investment schemes like private equity funds and venture capital funds, they are all applicable in a business at different stages of its life cycle. These sort of instruments and vehicles have been very, very slow to move in Sri Lanka. But now you will see people needing more of these solutions. And hopefully we do have a reasonably good regulatory framework that has already been set up for such things to operate. So I would see actually more activity on the capital requirement side spilling over into capital markets. So that's
Bingu, if I can bring you in, when compared to the region, I mean, you are representing the local branch of a global bank, right? When compared to the region and best practices in more developed markets, are the present changes in Sri Lanka's Banking Act suitable, you think, for a country in the state of development that Sri Lanka is in? I mean, this is a broad question. What's broadly your view?
You can debate it. The reality, especially the large exposure policy, is very common across the markets.
Right.
We've only seen one or two markets in our footprint where you don't have that kind of policy. I think we are late. So I think we'll have to implement. The other question is whether the timing is right, because we are coming out of a crisis. That's why we are given enough time. So there's time to, develop the capital market, go to the market and get more capital for the banks as well as for the corporates. So enough time is given. We have 3 years to go. But I can tell you most of the markets got a very similar policy. 25% of tier 1 is very common across the markets. But especially when it comes to RPTs, especially these independent directors of the companies and their exposures and their companies and all that, the real challenge in Sri Lanka is very small.
Now, you'll have to define for me what you're referring to here.
Yeah, so there is a related party transaction guideline under this, right? For an example, if you're in my board, if you're also in one of the other corporate boards, that corporate will have to I'll go through that corporate subsidiaries as well, and all those will fall under related parties.
Right.
So your exposures, your company's exposures, everything will have to go through a separate, review, and there'll be collateral as specified by the regulators. So that's a new challenge. The challenge is, again, it's very common in a lot of the markets, especially the developed markets. The problem is we have very small pool of resources being in the bank boards and the corporate boards. And in Sri Lanka, it's all interconnected. Corporates own banks, banks have exposure to corporates, and corporates have downstream, upstream operations, buying and selling under subsidiaries. So that's a bit of a challenge for Sri Lanka. I think we will struggle a little bit on the related party policy, be it how we lend, the influence and all of that. That will be a bit of a challenge for Sri Lanka in our view.
Malinda, I'm trying to fully grasp this idea about the impact of related party lending. If you build on what Bingu is saying, in a practical sense, what is it likely to result in? Will you see banks having to shed some directors because it's the most prudent thing to do versus those companies having to put up new collateral? How do you think this thing will play out?
Yeah, so that's the interesting part. I mean, very, very true what Bingu mentioned actually in terms of the challenges the banking sector as well as the corporates are going to have because of these directions. So I'll just also add to what Bingu said in terms of, Bingu mentioned about the related parties.
Yes.
But the act doesn't stop there actually. It also talks about connected parties. Now, the previous definition was pretty much on, your single borrower limits, SBLs, what we call as, is on particular individuals or corporates as well as the related parties. So now comes the definition of connected parties, and that connected party definition has also been broadened. Like Bingu said, you're a holding company, you're a subsidiary, all its material interest shareholders, all that are being now taken into account when you determine your single exposure limits, large exposure limits. And there is also a brand new concept that the new act is bringing in, which is called the economic interdependence. So now previously this was never been spoken of. Okay. So if as a company you are selling 90% of your sales, let's say to a particular other company, then you are economically dependent on that entity. Then you might treat the two companies together when looking at the large exposures. So the act really tries to tackle things in substance as opposed to limiting it to a formula or a particular rule in textbook. So this will give the right to central bank to assess the situation in various ways, and if they really see that these are connected parties, either legally or in substance, it has the right to call it out as a large exposure and to treat those borrowings together. So this will create additional burdens on the companies in terms of to what groups and what parties you can lend, because it will impact your single borrower limits, definitely.
So it's much like that accounting policy of substance over form, right?
Yes.
Somewhat like that. But in this case,
yes,
the regulator decides when substance overtakes form.
Absolutely. So under what context those decisions will be made is yet to be seen.
Right.
And how those decisions are being taken, or even your economic interdependence, at what regular intervals central bank can check it, and whether it is practical to assess those things in reality. That is yet to be seen, but at least in the act, that provision is there.
To the best of your knowledge, Bingu, such concepts as economic interdependence may exist in, I'm thinking, in other markets, right?
Yeah.
How is it? How does regulation take place around ensuring? How does a regulator enforce economic interdependence in other markets?
No, it's very common. So they will look at the board of directors and their exposures, as well as the existing investors, their exposures, and the exposure to those entities and their related parties, holding companies. Of course, there can be caps and things like that, but it's very common in a lot of the matured markets. To what level you will monitor and whether you'll fine a company, give time to remediate, that we have to wait and see. But we also have to understand that the regulator is taking a lot of powers under this act.
So you did mention previously several time frame thresholds that are. Don't those apply to regulations around economic interdependence and all that, or is that up in the air currently?
That's up in the air. We still have to figure out what it means for the banking sector.
So, Ruvini, we've talked about two aspects or two changes that are likely to come. One in the lending to big companies, the lending the banks do to big corporates, right? The second one, you talked about the impact that this may have on capital markets in Sri Lanka, which have been fairly poor source of funding for companies in general, so far. What about the other sectors? What about SMEs, consumer lending? What are the likely implications of the new Banking Act on banks' relationships with SMEs and also bank lending to consumers for mortgages, for credit cards and such?
So, Shamindra, I think with what Malinda and Bingu have been talking about, we see that the opportunities for, again, as I earlier said, for banks to reside in that comfort zone of the large corporates is going to diminish. So they will have to find new ways of managing more lending to SMEs. That means, again, changing your way of sort of running the banking business, because all SMEs, right now, banks are very dependent on collateral. right?
Yes.
So the moment you move into the SME market, that comfort is not going to be there for you, right? You're going to have to find ways to lend in more innovative ways to these SMEs. Their ability to repay can be volatile because they're small businesses subject to all kinds of vagaries in the market. So you have to take into account that volatility, the ups and downs that SMEs go through, the need to nurture them to grow to the next level. So banks are going to have to work really hard
Right.
to understand their new set of customers. Because without that new set of customers, particularly in SME, they will not have the ability to grow.
Sure.
Because it's only if that channel grows that you can also, then parallelly maybe get the opportunity to increase your lending to the larger corporates also. So it has to grow in parallel, in tandem. You cannot sort of not focus on the customers that you didn't focus on before. And when it comes to, again, individuals, as you said, retail customers, more credit cards or housing loans or whatever that, the personal sort of financial products that banks were kind of providing, that again will have to evolve. It will have to be more innovative, because there I think you're looking at customers' ability to access those services faster. Again, use of technology. It's not just physical access anymore, it's also a digital access. So you have to invest in all that. You have to also ensure that your service levels are up to date, that you can monitor cash flows. So the monitoring mechanism also will become more important, because you have to, again, without relying on the comfort of collateral, be able to figure out how these SME businesses are going to produce their cash flows and monitor their performance so that you can recover your loans. So I see a lot of new management challenges coming through, a lot of new investment coming through, and also the way they are going to sell products to their clients and provide the service.
So, Bingu, if banks are most likely going to have to rebalance their portfolios, right? Take more exposure to SMEs, take more exposure to consumer lendings. What are the implications on bank capital of doing that?
So capital is limited, like I said, Shamin. The real challenge for the banks will be, I completely agree with Ruvini. So there is no choice here. We'll be pushed to go into the SMEs and the personal financing. The real challenge is, we believe we currently work on a big brick and mortar structure. You have a branch, then you have SME clients coming in. Each relationship is managed like a mini corporate. So that will be difficult, because each ticket will be very small. SME tickets are like what you're thinking of, like lending 20 million, 30 million, 50, 100, max 200 maybe. So the ticket sizes are small. Even at a 3-4% margin, you're not making a lot of money. Even if you have a 6% margin, you're not making a lot of money. So platforms are critical. I completely agree with you. The way we do SMEs will have to change. Like for an example, we need to go to a platform like a Daraz and say, I'm going to finance all your suppliers. You go to another multinational or local corporate and say, large corporate, and say, I'm going to finance all your suppliers and buyers. So more platform-based lending. So by doing that, you basically through data, you come up with a model. These are like program lending, right? You have a program, you're 3 years with the supplier, no defaults, product is good, returns are low. You immediately approve like 50 million rupees. So that type of lending will have to kick in. You will not have the time to sit and write a credit application for 20 million, 30 million. So that change has to happen. But you touched on the personal finance as well. Completely agree. It has to be digitally driven, data driven decisions without using a lot of human resources.
So besides the cost of these new systems and processes, there is also the challenge of, what's the risk weight, so-called, right, on SME lending versus lending to a, AA rated corporate. Is it that banks will, again, if they reorient their portfolio, still need more capital to back SME lending?
See, personal financing and SME, especially program lending, the general risk weight is low if you look at the program.
Okay.
Right? But coming back to your original question, from where will you find the capital and the money? You will have to divest. There's no choice. You will have to divest and invest. Like for an example, you exit like 10 of your buildings and you invest in a digital platform.
Right.
And you onboard like 10,000 clients and bring asset base of 100 billion. That's the way to look at it.
Right.
So you will not be able to create space within your cost structure and the capital structure. So divesting and investing will have to be a big agenda. We've Stanchart, we've been doing this for the last, I would say, 7-8 years. That's a big agenda they've been driving globally, because that's how you find the money. So that, I think the banking sector will have to adapt and move on. But from a return perspective on program lending, returns are not bad. Yeah, capital consumption is low for retail lending generally.
So that's a total mindset change. Besides a strategy being a strategy change, it's a mindset change, right? You look beyond this brick and mortar led collateral that you're taking on the one hand, and you look beyond the brick and mortar that is in your books, like the physical assets that you have, not of customers but of your own buildings, right? It requires boards and strategic management teams to really change how they approach banking, I think, Ruvini.
Absolutely. Yes, because it's not going to be banking as we know it now, right? It will be quite different. And I agree with Bingu on platform-led lending. So you will have to have a lot of technology and data that you use, because you cannot spend a lot of time evaluating a 20 million or a 30 million application. There will have to be some kind of parameterization of your evaluation, and then you get an answer very fast, because the customers also will expect your turnaround time to be faster. Because some banks will move, right, and they'll be agile. Then the others will have to also play catch up and do it faster. So everything, I mean, banking as we know it is going to evolve, right? Maybe gradually, maybe faster.
Malinda, when we were starting off this conversation, Bingu said that 3 areas are impacted due to this act, that is capital, equity and governance, he said, right? One of the regulators or the government's stated objective of bringing in a new banking act has been to enhance the risk landscape as it relates to banking and the financial sector, right? Do you think this objective has been met by the act that is on the table right now?
Yes, I mean, so if you look at the different things the act is bringing onto the table, I think few of it we have already discussed. I think single borrower limit is a key aspect. If you really look at it, the reason why we have it is for risk management purposes. Now you are trying to dilute the risk of borrowing to a single person or a group. Then some of the other things that we discussed about in terms of shareholding, having the banks control with one party or having few parties significant influence over a bank. By diluting that, again, you are trying to de-risk banks. So similarly, there are other provisions in the Act as well that is talking towards the risk management. So one is again on capital side. So there are a number of initiatives where now the central bank can bring more customized regulation to a particular bank as opposed to a tailor-made or hard-coded regulation to the banking sector. So looking at your loan book, looking at your type of business, the central bank can now dictate a different capital ratio to you as opposed to another bank. So that ability has now been brought to central bank by the Act. Similarly, on liquidity, again, central bank has the discretion to bring specific rules to a specific bank looking at their individual circumstances as opposed to a one-size-fit to all the banks. So to me, looking at these aspects, it's definitely they have kept the right, the foot towards the right direction in terms of bringing more risk management into the banking sector.
So by extension, does this improve financial system stability in Sri Lanka, you think? Does it do so at the cost of something very significant?
So, Bingu did touch upon on cost of compliance when he started the conversation. So there is a cost to doing everything. And then he also touched upon whether it's the right time to bring that. We all do agree that we are just coming out of a financial crisis. But like you said, there are certain transitionary provisions and there are timelines within which we have to comply. But again, go back to your original question of are we going towards the right direction in terms of proper risk management and financial system stability? I think the answer is yes. So we are achieving that objective.
Bingu, Sri Lanka's got a lot of banks, right? And for the longest time, this conversation has been ongoing about how do you create the conditions, should you, and how do you create the conditions for more consolidation in the sector, because that will bring costs down and, it's good for the whole ecosystem, the economy, if cost of intermediation came down in Sri Lanka. What does the new law do towards banking sector consolidation?
So regulators will have a lot of powers in terms of directing certain things at the right time. Of course, they'll wait for this. In my view, they'll wait for the large exposure policy to kick in and see how the banks perform. And like Malinda clearly said, I mean, regulators can dictate terms in terms of what should be done. So that's one big aspect. Even for foreign banks, they have put a clause saying that they would like to see subsidiarization. We still don't see clarity, but in a lot of the markets, we have seen a lot of the matured markets, of course, they are pushing for subsidiarization for better control. But there's a lot of, again, there's a cost attached to it. Overall, Shamindra, my view, I think this is good. Timing we can challenge. With a little bit of negotiation, I think we are heading towards the right direction because you're broadening the base, you're accessing more SMEs, more personal financing, more startups. Then the large conglomerates will go to the equity markets. The market will mature, market players will come. It's all good, just timing and how we approach it.
So just to add one thing there, Shamindra, on consolidation. Another thing that the Act has done is it has brought in the ability for a bank to consolidate a licensed finance company, which was previously not there. So in terms of consolidation, previously what a bank could do was to consolidate or merge another bank.
Okay.
So you didn't have the right to merge with acquire or merge a finance company. So this Act has clearly given that right to the banking sector as well.
And what you were referring to there, Bingu, the fact that sometimes foreign banks may be asked to set up a subsidiary, a fully owned subsidiary, if at all, in Sri Lanka. Because currently, just to clarify, you operate as banks like Standard Chartered or any other bank as a branch of the central organization, right? So you are essentially an extension of the same balance sheet as the parent.
Correct. And the rating.
And the rating, of course, yeah. And why does that increase cost, you think, if you were to become a subsidiary and be incorporated in Sri Lanka?
Yeah. So local capital, local boards, local governance, all that will have to kick in. The board governance for a global bank is very, very stringent. The other biggest challenge is banks like us. We control a significant part of the correspondent banking business. We advise a lot of LCs. So having the AAA rating locally as well as when we direct these transactions, it's very easy and good for the country. So in a lot of the emerging markets, if you look at it, a lot of the global banks are branches, not subsidiaries. But markets like Singapore has pushed for it. Mauritius have pushed for it. Some countries like Tanzania, interestingly, they're subsidiaries. But a lot of the emerging markets, historically, because we've been here 130 years, right? So we've always been a branch, and that has its own benefits as well. We have the support of the head office for capital support and all of that. So that gives a lot of stability.
As we kind of wrap up this conversation, can I first pose this one question to all of you, right? If you look at the impacts, both negative and positive, right? And there can be negative impacts because at least in the short term, many of you, all of you around the table agree that there can be negative impacts in the short term, right? In your view, what is the downside that banks have to be, the number one downside that banks have to be guarding against? And what do you think is that immediate benefit to Sri Lanka's financial system stability, the bank, financial sector in general, that this Act brings? So one downside. And what's that immediate benefit? Can I start with you, Malinda?
I think starting first is easy on this one. So I guess cost is like what we have all discussed.
Right.
The point in time in which we are approaching this, as well as cost, is the main downside.
Right.
And I guess the main advantage is this will definitely ensure financial system stability in the longer run. So that's, to me, is the most important thing.
That you can take it in a macro point of view or a micro point of view. It's up to you. Ruvini, what do you think is the upside and the downside of this in the short term?
So the downside, Shamindra, is that there is, as Malinda said, there is a time frame that has been given. But the banks will have to do a lot of work internally to meet those time frames. And that will be a lot of effort that they have to put in. So it depends on how fast bank boards and management will react, and their ability to, meet the timelines effectively will be a challenge, not a downside really. If you look at the benefits, I'm still very much advocating for this broad basing and going for SMEs and, more personalized lending. You see a couple of things happening in the environment which will also hopefully help towards that. We don't have a lot of details in the public domain yet, but there has been communications regarding the setting up of a credit guarantee institution. again, that will encourage and sort of mitigate the risks that banks have to face when they lend to smaller customers. So setting that up is definitely a good step in the right direction, because it will help banks to take that journey faster. Also, I think there was an announcement regarding a secured transactions registry. Right now, we were using only movable assets as collateral. Now you can also use movable assets. So the faster that those sort of things evolve, I think the journey that banks have to take towards broad basing their customer base will be it'll be helpful to them.
Bingu, in the short term and the long term, you probably already touched on these, but if you were to be concise about it, what do you think the impacts will be?
More upside. Is
Right.
the timing we can debate, the process we can debate. More
Sure.
upside, because this will bring more governance, more than anything else, right? The other important aspect is this will drive a capital market behavior. That's what we expect in the next couple of years. Capital market will get activated. And of course, the new Tier 1 capital, new right issues, foreign investors will come to the market, Sri Lankan banks will be known. So that's a big positive from that perspective. I don't see a big downside in terms of implementation, especially on this related party or the connected parties. We might run out of board members for the banks. That's my only worry in the short run, because we are a very small group of people running the business in Sri Lanka, right? So you're a director here, director there, you're independent, but you're, as a professional, you join a corporate board and you're also in a bank board. Now, suddenly, if that corporate has to bring in collateral simply because you are an independent director in a bank, that becomes a big problem for that director. So banks might find it very difficult to find independent, good people joining the bank boards. That's the only problem I see in the short run, because we are a small market. But it'll evolve. People will come to the market. More professionals will get a chance to be in the boards. So it'll change. Overall, good outcome.
Malinda, Ruvini, Bingumal, this has been a wonderful conversation. Thank you. We covered a lot of ground, and I really appreciate your thoughts on this.
Thank you.
Thank you.
Thank you, Shamsi. Thanks.